Why, hello there. It's Sunday, and that's my fun day. How's everybody doing? Those of you that are here, oh boy, is it functioning correctly? That's the question. Okay. All right, looks like it's actually working now. So, just want to talk about what I'm looking forward to the week ahead. Those of you that saw the CFK weekly recap that came out at noon today, you know that I've been a buyer of Amazon lately. By the way, anybody that joins, let me know about how the background music's hitting. Very interested in that. So, I haven't used background music in a live before, so I'm just trying some new things. So, with Amazon, I've been a buyer around this level. I started actually when it was around $199, thinking that that was relatively fairly priced. And I've basically been a buyer throughout any pullback that it's had since then. And my dollar cost average is pretty close to 180 now. And I'm hoping to accumulate up to 100 shares before it gets up to 200 again in the future. And I do think it will go to 200 and beyond in the future, obviously due to the performance of the business and just how strong their cash flows can be. I want to take a look quickly right here. So this is their current price to operating cash flow. 17.21 is the current price to operating cash flow for Amazon. Lists of businesses that are more expensive than Amazon today. I think Chipotle is on that list. I think McDonald's is on that list. Apple certainly is on that list in terms of operating cash flow. Now, obviously, their free cash flow multiple is 38 because of the fact that they still have a lot of capex, but it's improving rapidly. That's the thing. For fiscal year 2023, the price to free cash flow was about 48.5, with a price to operating cash flow of about 18.4. Now, that price to free cash flow has improved to 38 times, while the price to operating cash flow has only gone to 17.21. So, relative to the cash flow they produce, the price is getting more and more attractive over time. At this point, I think now, I was waiting on Amazon until it became obvious. A light bulb moment went off in my head. And now is that moment, basically. So that's why we've got all of this Amazon accumulating. So, do we have anybody in the chat? Guess it's harder to get live views on a Sunday when it's not MPW earnings. So that's what I'm liking about Amazon, and I expect I'll be buying more this week. Next up, Walt Disney Company. Now, this is one where it's really about the margins pre-pandemic versus post-pandemic, in my view. So we've got, let's see. Okay. So, and I don't know, hopefully this comes up nicely, but basically, pre-pandemic, they were at roughly 13.5% operating margin, right? And the thesis of everybody that was buying when the stock price was getting hammered was eventually they'll get back to those margins. Now we're at, well, actually we're higher. We're closer to we're closer to 15% now. All right. So, if anything, I think that this is a signal that their profitability has basically recovered on an operational level, and we just need free cash flow and net income to catch up. All right, so this guy, all right, MPW. Okay. So let's take a look at our good friend MPW. So it's been getting hammered. All right. This last week has been pretty terrible. They had a nice run up after earnings, which made me think that the market actually liked the earnings report. But to me, it looks as though maybe that those might have been perhaps HITI's more important clients bailing out, if that makes sense. So I think because HITI took it off the short list, the public short list, the following week, which I'll give you guys a few seconds in hopes that this is a skippable ad. And all right, so what I suppose is that HITI has maybe some higher paying private clients, and they had them exit after the earnings release, right? And then they took it off the public shortlist the following week, basically so that their people could get out of their short positions. And then if the people that got into the short position because it was on the public shortlist, they can have their, bum rush to the exit if they want. That just has not happened. Okay. We don't have a short squeeze occurring at this point in time. Doesn't mean it could never happen, but I think we're waiting to see what the latest data is on sold short shares. At the moment, it seems to be like we're just languishing in the mid 4s to high 4s without really much movement. Obviously, the dividend being 8 cents is disappointing for a lot of people. You see a lot of people ask about the dividend every time we cover earnings. That's like the main focus of a lot of people that buy this stock. And I've said pretty much since the beginning that if you're buying it just for the dividend, that's the wrong reason to be buying it. Because of the issues they're going through, you can't consider that dividend as safe. So I got in late 2022. So but that was like only a very small amount, but I am approaching the 2-year mark on this. So obviously I would like it to play out sooner than later. There is, of course, Ed Aldag's bonus. He basically gets a big compensation windfall if the stock hits $7 a share, and then an even bigger one if it hits $10 a share, but that's like tied to this year. So I'm sure he's motivated to pull out all the stops and make things happen in the Steward bankruptcy and everything. So we just need to wait and see if they can actually execute. The good news is, in prior tenant bankruptcies, they have come out decently well. But Steward is so much larger than any of those other situations that it's a little bit touch and go, right? But I think all in all, like the bulk of the evidence is that they can navigate it and that it is worth more than it's trading for today. I mean, my cost basis is a little over $6, so I'm still eating like a 23% red on this. So obviously, my hope is that that's correct, and my expectation is that's correct. I put more into it when it was at $3, which that was hard to do, by the way. When you're down like 60, 70% on something, and the price and it just every single article is saying why it's a turd, it's very, very difficult to be confident in your own assessments and go against that and actually put more money on the line. However, in this case, it's like you really would have had to believe that it's going to zero to sell it when it was back in January, when it was like $3 a share. Otherwise, there's almost no reason why that would make sense to sell it rather than buying more. So the Steward, they keep doing everything they can do, it seems like, to try to slow down their own inevitable demise. I really think Steward eventually is gonna just be nothing, or it's gonna be whatever's left of it's gonna end up being owned by whichever lenders weren't made whole during the bankruptcy process. So the first priority people are probably going to get paid out. And then when it gets down to like the third, fourth, fifth priority creditors, they're going to just kind of own whatever is left at the end, but it's not probably going to be a whole heck of a lot, I would imagine. Steward is just, it's been so mismanaged. And somebody on my Discord brought up the good point. Doctors generally aren't business savvy, and Ralph De La Torre, their CEO, he's a doctor first. He's like a cardiac surgeon or something like that. So it doesn't surprise me to see how mismanaged Steward is, because it's doctor owned. Doctor owned business is actually not a selling point. Give me just a sec. Yeah. So Steward is obviously, they're going to do everything they can to try to stay a business and survive. Basically, the lawyers that represent Steward, it's their job to represent Steward's interests. Steward is their client, so it's their job to make sure that their client comes out of this at least still existing, right? Or to at least try every single move they can legally to try to make that happen. Like, as long as it's within the bounds of what's legal and ethical to try, heck, even seems like in some cases even borderline of what's ethical, but they have that obligation to their client. And an attorney's duty to the client is kind of the foundation upon which our whole adversarial legal system is based. So I don't necessarily blame them for acting in their own self-interests. But I think that MPW has the stronger case in almost every instance where some other party or another is going against them in this steward bankruptcy. And that includes the other creditors too. They, of course, they all want the master leases, etc., to be ignored and for everything to be bundled together because the real estate's where the value is. So, of course, they want MPT to give up real estate value in order to make more transactions go through so they can be made whole. But MPT says, hey, we own this real estate. We have rights as the owners. Now, Massachusetts was a big pain in the butt. It started to get, you started to see things like eminent domain come into play, where the government was really getting heavily involved and really heavy-handed with it. So with Massachusetts, considering how much of a quagmire that was, I think the reason that they basically just gave back the keys to the secured lender is twofold. One, they bought those properties and formed a joint venture. So somebody else had half the risk in the Massachusetts hospitals to begin with. And then they took out a bunch of secured debt on those hospitals. Basically like if you were a real estate investor, it's basically like a sort of a cash out refinance where their only recourse is basically to go after the asset that it's secured against. And so basically they milked it for as much as they could. And really, there's other Macari and Apollo are the ones that got burned probably more so on Massachusetts being walked away from, because MPT got, the cash out, basically the secured financing on it, plus split the risk with the joint venture partner and collected rent for however many years, right? So even though they walked away from some equity on paper, they really did squeeze it for everything they could while they had it. And I think that's what Fast Eddie is good at, taking these bundles of hospital real estate and really maximizing what MPT gets out of them while they own them. And if they end up selling them down the line like they have been now in order to pay down debt and other things, they're getting attractive valuations even in the high interest rate environment. The Utah joint venture where they sold 75% stake in a few hospitals for it was like 800 and something million, but then took out some more secured financing on the 25% they retained. That implied values that were well above what the balance sheet shows for that real estate. So I think in terms of the hospitals that are on their books, they probably have more value than what's on the balance sheet. But the non-hospital assets, things like equity in stewardship, equity in prospect, things like that, those are the things that don't really have a really accurate valuation on there. And it could go either way, but probably they'll get less than what they were, which is why they've done the impairments and such that they've done. So yeah, that's kind of where it's at with MPW. Let's see. Yeah, and these analysts' estimates here have not been updated in forever. It's said high 10, low 4 forever. They got upgraded after January. Like in January, the low was showing $2. Of course, it was Deutsche Bank, the lowest common denominator of investment banks. They were like, oh, the stock's down a lot, so our target's going to be $2. And then, of course, when the stock went back up, they raised it to $5 because their price targets just follow whatever the stock price happens to be doing in the recent past. It's nothing. They're not like actually looking at the assets and saying, they sure have a lot of assets, and you know, their assets exceed their debts by X amount. Maybe it's worth a little bit more. No, it's just, oh, the price is down a lot, therefore the price target goes down. The price is up a lot. Oh, we better raise the price target. Yeah, AI price targets, exactly. The AI, Chat GPT, Optimus Prime. But yeah, and I also think it's important that people remember that whatever the yield is you're getting in a data feed, if it's trailing, don't trust it. You're not getting 11% today. I think it's roughly 7% at the 8-cent payout level, but they're really doing the dividend quarter by quarter at this point. And that's been the case pretty much this entire year so far. They delay the announcements. Well, this time actually they didn't delay it that much. And they actually talked about the dividend during earnings, which was new. They usually, so far this year, they've kind of left the earnings as like a mystery during the earnings conference call. And then waited and waited and waited and then released it when I think they thought it would do the most damage to the shorts as far as moving the price. That's some trench warfare stuff they're doing there. But yeah, it's been a tough week, a little bit of a bleed off, which it's weird that it would go up so much on earnings and then bleed off like this. But I think you see all the delays and things happening with Steward, and I think people don't like the uncertainty that injects, and so you see a lot of people just kind of sell off. Yeah, you see, oof. Now, people's favorite gotcha, of course, is the 5-year chart. Oh, it's down so much over the last 5 years. Look how much the S&P 500 is doing. That's kind of the lowest common denominator of investing. The 5-year chart matters if you bought it 5 years ago. That's all I'll say about that. Now, if they could pull up the chart of what it's going to do over the next 5 years, that would actually be relevant, but they can't. Nobody can. So, there you go. So, by the way, chat, do you hear the background music at all? Oh, you know what? I might not have looped it. All right. Would you say you hear it now? By the way, I've never done background music on a live stream before, so it's the same as what's in all my videos. So people are used to hearing my voice side by side with that background music. Would you say it's loud or just quiet enough that it's bearable, not too distracting? No, you didn't miss grab. I didn't put them in any particular order in the title. It's loudish. Okay. Did that affect it? All right. All right, I just dropped it a little bit more. No change. All right. How about that? No change, kind of loud. It's good to me. It's good to you. How about... All right, cool. Yeah, I don't really want it to be... I don't want it to be a distraction. I guess I'm just trying to like find that happy medium, because it is definitely... Ooh, okay. Oh, yeah, that Disney Plus arbitration. So, yeah, I bet if we go to the front page of that, probably it's in. Yeah, Disney, wrongful death, legal case exposes potential pitfalls of automatically clicking I agree. Yeah, so anytime you sign up for any streaming service, Disney Plus, whatever, you're agreeing to arbitration if you ever suffer any loss because of anything Disney related, basically. Leaf, I do not generally groove to this beat with my lady friends. Yeah. I know some people don't like MPW all that much, but I like it. I mean, it's okay at today's levels. I think we'll probably see it be on the low end a $7 or $8 stock, on the high end like an $11 or $12 stock. I don't think I see 15 happening again anytime soon for MPW. I think it's been too beaten down for too long. It's going to suffer a little bit similar to PayPal, where it came down so much and burned so many people that it's going to take sentiment a little bit of time to turn back around fully. So it's going to suffer and languish a little bit due to perception. So somebody mentioned Grab. High risk YOLO play. Love it. So Grab has been a funny one. Kind of sideways, really. Like, I got into it. I think my first buys were around like 317 or something. And we're just kind of sitting here. Now my average is up because obviously like I've just continued to buy it all throughout, including when it was at its recent peak of 374. Yeah. So the fun thing with Grab is, for some reason, they had a good earnings report, but the stock price went down. It doesn't seem like the share price really responds all that well to good earnings for some reason. And in the long run, that should benefit anybody that's accumulating, because at a certain point, the money's going to be there and people are going to say, hey, wait a minute. It's not like it's going to trade at like a low single-digit multiple or something. By the time it gets there, the market will probably realize what it's missing out on. But I think people are sleeping on the fact that it has the same core business model as Uber. In fact, Uber owns a pretty sizable chunk of their equity. The Uber's CEO is on their board. And they don't have a terrible money-burning freight business. They do have a fintech business that eats up a little bit of... It has some cash burn to it, but the metrics are improving as time goes on with that. But we have a balance sheet with $4.6 billion net cash. At their earnings release, they listed their net liquidity at $5.2 billion. Debt is negligible. I'm seeing $295 million of debt versus around $5 billion of cash and equivalents. Okay? This company has a deep war chest. The rideshare and delivery landscape in Southeast Asia. I've been to the Philippines 3 times, and Grab is everywhere in Manila, at least. I haven't really gone into any of the the other towns, the provinces and stuff. But it's probably also in like, I would imagine it's also in like Cebu and General Santos City and some of like the other bigger cities around the Philippines. But in Metro Manila, it's like the streets are littered with Grab drivers and Grab delivery guys on like bicycles and motos and stuff. So it's everywhere. And the only competition that they have in the region they operate are single country competitors. So they may have a couple of specific competitors in the Philippines, like they're competing with the regular metered taxis on ride share or whatever. They're competing with like Food Panda on food delivery, and there's a different one that they're competing with in Indonesia. But none of these single country competitors are like a threat to them in the overall region. I don't know why they're assigned a no moat rating by Morningstar. I think they do that because of the fact that their delivery business is just under break even, so maybe they don't think that's a moat yet because it's not profitable yet. But certainly their rideshare business seems like it's developing a moat, because it's literally the best option there. It's cheaper than taxis. You get charged the same rate. So regular taxis there, if you're a foreigner, they will charge you a higher rate than if you're a local. And they will do it blatantly. They don't even try to hide it. Grab, you order it on the app. The amount you pay is the amount you pay. It's set by the app. They do not rip off foreigners. So tourists, I think, are going to mostly use Grab as if they know about it before they go. That is maybe a potential issue. I don't know if they're advertising specifically to tourists who come over. I had contacts over there that told me, hey, before you come over here, you need to download this app called Grab. Trust me, is basically what they told me. And it turned out to be a great idea. It functions every bit as well as Uber, by the way, for rideshare, and as well as Uber Eats or DoorDash or Postmates or whatever for food delivery. Yeah. So this is right now, depending on the share price, it's either my third or fourth largest holding. And it's a little bit in the red, but I think people sleep on it. And this is one where, believe it or not, I do kind of agree with the strong buy rating. Because they have a war chest, very little debt. So risk, I think, is lessening and lessening over time. There is a little bit of dilution now. Now, there was a lot more in the past, which I think they used share dilution to get through the pandemic, probably. But actually, let me do the quarterly on this. So gross margins are now above 40%. Which is pretty good. I think that's probably where they want it to be, maybe a little higher. And more importantly, we've got positive free cash flow. Now, unfortunately, this number is slightly deceptive. Their free cash flow, as stated in the data feed, is not adjusted down for people who deposited money in their online banking segment. So their free cash flow is actually a little bit lower than this. So when they release their earnings, they do what's called adjusted free cash flow to basically fix the amount and reduce it by the amount that people deposited in their online banking, because that obviously isn't really operational cash flow in a proper sense of the word. That's money that's just being held in accounts that they can just withdraw later, so they adjust that out to get you the real free cash flow number. But they are positive on free cash flow. Net income is still negative 1 penny, but they're very close. They're very close. And I think they string together some positive EPS quarters, maintain free cash flow positivity, and they could very well have their Palantir moment. I think the fact that they're an international stock, though, so I haven't really looked at cruises. I honestly, because I have Disney now, I have exposure to the cruise business through Disney. I don't know if I would want to go like with a pure play cruise line. I think just having the exposure to, I guess, in-person entertainment, or, you know, theme parks, cruises, that kind of thing, through Disney is probably enough. So, which is part of the reason why I actually got out of Comcast when I decided I wanted to get into Disney, because, like, hey, with Comcast, you have Universal Studios and whatnot. And I already also have other stuff in streaming, like Paramount with Paramount Plus and all that, and Amazon with Amazon Prime Video. So to not be like too overly stacked in one segment, I kind of like, okay, do I really need to have Comcast and Disney? No. So that's pretty well the situation with Grab. I think over time, the market will realize that this is a great opportunity. Now, compare and contrast that to Uber, right? So Uber obviously, for the most part, produces positive EPS now, although they do still have the occasional negative quarter. But look at Uber's gross margins compared to Grab's real quick. So Uber's at a 33% gross margin versus Grab's 40%. They're in the same business, at least for their core business. What would you rather be invested in? Good question, right? But wait, there's more. Let's look at Uber's balance sheet. Oh, what? They've got... Now, their balance sheet's not terrible, but they are a lot more levered than Grab is. They have their net debt, which is, you know, the difference between debt and cash. They're in the hole by 1.86 billion. Now, that's not a ton for a company the size of Uber. They do still, you know, they've got a pretty good amount of cash sitting there that they could pay off most of their debt with. But that doesn't change the fact that Grab's balance sheet is actually way better. Okay. Uber's book value per share is $5.89, tangible book $143. What about Grab? Now keep in mind, Uber is like $70 a share or something like that, whereas Grab is like $3 and change right now. Book value per share $1.50, tangible book $1.35. So the tangible book per share is practically the same, whereas one is like $70 a share and the other is like $3 and change. Which one has the better balance sheet? I'm having trouble figuring this out. So yeah, that's why I like Grab, and I think Uber is a pile of doo-doo, to be honest. And a lot of that problem, the issue with Uber's gross margins comes from their freight business, the cash burn and the debt. A lot of it probably came from the freight business. And Uber still dilutes, by the way. So the dilution thing isn't just a Grab issue. But with Grab now, it's mostly just stock-based compensation, and they have a buyback plan to take care of that. So I think dilution will be coming to an end soon with Grab. So yeah, if you're in Uber and you think, no, I don't want. Now, granted, you do get exposure to Grab through Uber since they own stock in the company. But I just think overall, when you own Uber, you own things that suck, i.e. their freight business, and therefore why own them when you could just buy Grab? Now maybe it's because Grab's only in Southeast Asia, but in the long run I don't think that matters. You look at GDP trends, birth rates, and per capita GDP growth in Southeast Asia, and it looks pretty good. And it's not in China either. It's based in Singapore. So you don't have that China risk either with Grab. So love Grab. Now, I did mention high tide in the title thumbnail. This is the Canadian cannabis stock. Now this one is also somehow an analyst strong buy. Surprised to see that with a weed company. But what have we here? So it's a small cap for sure. The trading volume on it is like ridiculously low. Now their PE is still non-existent because we still don't have GAAP net income, but price to free cash flow and price to operating cash flow, right? Price to free cash flow 7. Price to operating cash flow 5.7. I think that's pretty disgustingly good. And the fact is that they're at, I think, 11% market share in Canada right now, with a goal of getting to 20% market share. Tilray, I couldn't tell you. We can take a look. I'm not very familiar with Tilray. Tilray does not produce positive free cash flow or operating cash flow. So I would say high tide pretty much eviscerates Tilray. Yeah. Tilray is not even I don't think I'd touch Tilray with a 10-foot pole. I wouldn't invest in Tilray with Khmer's money. That's how I feel about Tilray. And now back to high tide real quick. We've got, I think, let's see, their balance sheet last I saw was pretty good. Now they definitely do use some They and it may not show in the data feed right now, but I think they had just signed a deal for some debt to use for expansion. And I think the stock actually went up on the news. But they're certainly not like super debt heavy. So their net cash versus debt is, and this is $32 million. That's not that terrible. Yeah, because their quarterly free cash flow in the most recent quarter was $10.7 million. And remember, this is a small cap, so I know these numbers don't sound big compared to a lot of the other companies we cover. And they've got 4 sequential quarters of positive free cash flow, which the last one was actually the highest they've ever had. So I would say things are going pretty well for HITI compared to other cannabis companies. And if you think that the US election is possibly a bullish thing for legalization here, they do have sort of, I would say, an outline of a plan to enter the market. And Germany, they actually had recently posted a job posting for some type of operations manager or something for Germany, because I know they were working on something to expand over there and get a foothold in the German market. Because I think Germany just recently eased up on their cannabis laws, so that could be a big. I mean, Germany is one of the biggest economies in Europe, and in fact, Germany may be the biggest economy in the European Union, if I'm not mistaken. So that would be a pretty big deal if they got a foothold in Germany. Like, I think Germany's economy is bigger than Canada's, if I'm not mistaken. But yeah. Then finally, we do have Clover. So this is one, actually, I lost my shares because I had set a stop loss basically to lock in around 100% gain, because it's so volatile, like, and I was up so much on it, and it happened to touch my stop loss and then go right back up. So I lost my 1,000 shares, but at about close to 100% gain. As you can see, the beta on it is 2.11. So it's a little more than double as volatile as the overall market. Yeah, I know. It sucks when that happens. So the thing with Clover, and this is kind of the main reason that I took a chance on it, is because you see, now I know this looks really ugly, but you see these instances of positive free cash flow, and the stock price was beaten down to about $1 a share. And so they hit a second sequential quarter of free cash flow, and then this wasn't actually the thing that I think sparked it. There was news that came out about an insider buy of $1 million, which then was the catalyst for this huge run up in the share price. Because this is not a huge market cap. Now, it's over $1 billion now in market cap, but still a $1 million insider buy is pretty big for a company this size. Yeah, it was definitely in the speculative pile. That's why it was such a small percentage of my portfolio. But it ended up being, 100% gain for me. Yeah, Citadel bought some shares. Yeah, some hedge funds and whatever bought some shares, but I think it was the insider buy. And if you look at the breakdown of the ownership of CLOV, I think it has a large percentage of retail ownership. It has kind of a cult following behind it. Maybe not as much of one as like a GameStop or an AMC, but if anything good happens with it, you have a lot of people that like just literally will not sell their shares because they've been in it and averaging down since it was like $7 or $8 a share. And they've worked their cost averages down into the $1 to $2 range over this time, just consistently buying it. Those people feel emotionally invested in the stock and are going to be reluctant to give it up until they really, really get their bag. So that combined with an insider buy, maybe some institutional interest for the first time in a while, the sequential quarters of free cash flow, yeah, it led to a big run up in the share price. Now, it could still run up more and everything, but I'm glad that I got into it when it was relatively low, got a good gain. And I actually still have a little bit. I have a few hundred shares of this in my Vanguard account, which I barely ever look at, so I kind of forgot about it. And so I'm going to let those ride and just see where it takes us. If it gets higher again to $6, $7 a share, then I'll have, a little bit of a windfall there, I guess. But yeah, for now, I'm happy to have gotten my gain on this because, as Leaf said, it's, it wasn't Leaf that said that. It was Okold that said it. It's still a little bit inconsistent. That's the thing. And they only have still 80,000 people on their Medicare Advantage plans. So there's still a small fry in that industry. Now, if their Clover Assistant leads to better outcomes and better profitability, maybe something like a United Healthcare or an Aetna or a Humana or something, maybe they want to buy Clover out, absorb the 80,000 customers and get their hands on that Clover Assistant technology. It's getting maybe a little bit of an AI boost because they're now categorizing the Clover Assistant as sort of this AI assisted thing to help with preventative care and stuff like that, and spotting issues before they become big issues. Because in medicine, typically if you catch things and treat them earlier, the cost is lower on the insurer and on the, honestly, on the Medicare system, which our taxes pay for. So I think that would just be a net good for everybody involved. And of course, your actual life expectancy and health outcomes are better usually when things are caught earlier as well. So this is one where I think the actual company is doing something that could potentially be not only a net good for shareholders and profitability, but also for their customers and for taxpayers. So pretty cool stuff that they're doing, but it doesn't produce enough for me to think of it as like a really, really long-term investment with the amount of cash flow they're producing and how inconsistently they're producing it. But I'd say Amazon for sure is high degree of confidence that the future looks bright for Amazon. So I'm happy to have a good amount of allocation there. It's my favorite Mag 7, and I like it a little. Like it edges out Google for me because, one, there is that little antitrust thing going on with Google right now. Two, I think Google's a little more sensitive to advertiser fluctuations. During bad economies, people's ad spend might decrease, which might decrease Google's revenue, but their cloud business is growing really fast. But Amazon's cloud business is going really fast. Now, I get that Amazon's e-commerce might suffer a little bit when the consumer is weak, but at the same time, it's kind of sticky. I think the convenience of it and everything else. Yeah, actually, Zolcold, that's exactly what I'm doing as well. My cost average right now, I think, is close to 180, and my plan is to try to get to my desired allocation before it hits 200 again, which I believe is probably inevitable. Although, like, hey, maybe I'm wrong and it falls in half from here. That would be more typical of the stocks I buy. But yeah, it's definitely my favorite of the and the amount of capex they put to get to the dominant position they are in e-commerce is in and of itself kind of a moat. I don't think anyone at this point in time is really eager to try to duplicate that. It was a decades-long undertaking. Oh yeah. And that's the other thing. They're getting into the pharma space, right? Yeah. yes. I have. It's my third. I think Amazon's right now my third largest holding. It depends somewhat on the day-to-day share price. Actually, MPW is still number one. British American Tobacco is number two, which I didn't talk about today, but I think I'm pretty happy with what I've got in British American. I'm just going to let it run. And I think it's Amazon, then Grab. Yeah. So Amazon's definitely, it's a contender maybe to be my number one, honestly. So, but I like the fact they're getting into delivering medicine, which I think actually is probably going to, that might hurt. Well, certainly Walgreens, which I'm not in anymore. Oof, what a blunder. But like Walmart has their own, their pharmacy. Kroger grocery stores often have a pharmacy in the store. Are those going to get hurt if people can just get their meds from Amazon? It's like every regular brick and mortar retailer is always having to adjust to the fact that Amazon exists, and the ones that fail to do that, it seems like they just at some point the decline happens and it's fast. So yeah, Amazon's basically, there's so many different things that they're able to get into and then start to dominate because of how wide their network is. They cast such a wide net. Any space Amazon decides they're going to branch into, they can almost immediately become a pretty dominant force. It's pretty crazy. Honest Virtue, I also, transportation and supply chain, logistics, etc. Yeah, that's what I do for a living as well. I've worked with Amazon a little bit on certain projects when they more in 2018, before they brought a lot of their logistics internal. Yeah. So, but yeah, I got to kind of see what the buildup was like. Now, honestly, it seemed really disorderly and like an absolute cluster whenever they would build a new distribution center. But honestly, like, I think that's to be expected with so much going on and how ambitious they were. And it's definitely paying off now. And the funny thing is, oh gosh, I don't know if it's exact, but okay. Yeah. So in 2021, they were more expensive than they are today. Isn't that crazy? Now, obviously, if you bought at like 75, 80, 85 bucks, whatever, you're the GOAT. Okay. Good timing on that. But right now, they're cheaper than they were in July of 2021. Yeah, that's probably the tough part working with Amazon is, yeah, you're at the end of the day, compare like anybody that works with Amazon or anything like that, nowadays tends to just be a number because their size and scale is just so huge. And everything they do with outside transportation partners and things like that is pretty much done through like a portal and stuff. Generally speaking, there's not like a way that you can call and like actually talk to somebody over there. It's it's pretty impersonal and has been that way for quite a while. But they got that Bezos money, you know what I mean? So they're really great to work with from that perspective. There's so much to like with Amazon. And I've heard from people that are pretty well informed that cloud is still early days and that is going to still grow quite a lot for the coming years. So that's pretty well, like, I think Amazon, again, up to 200. Disney, probably as long as it's under 100, still may be interested in adding more. I don't understand how anybody is not taking cloud into account with Amazon, though. Like, the fact that they have Amazon Web Services has been a thing for a while. But then again, like, I'm in PayPal, right? And there's still people who say, nobody uses PayPal anymore. I use Venmo, not realizing PayPal owns Venmo. It's like, what you're saying is a non sequitur. If anything, it bodes well for PayPal that you're saying that. And of course, MPT. I'm honestly probably not going to be adding much more to this one. I'm at 3,500 shares. I think that's enough. If it gets to, honestly, like $8, $9, I'll be starting to think of my exit strategy with it. It's been a very long journey, and I feel like it's just one of those things where I would like to be able to move on and think of other things, but instead it's constantly covering stuff with the Stewart bankruptcy and everything. Now, MPW videos get the most views on my channel and like get me subscribers and things like that. So that's nice, but even still, I hate having so much of my bandwidth tied up in one stock, if that makes sense. Because there's always some other angle to cover with them, and the rabbit hole always seems to go deeper. Oh yeah, Alex Chris is, he's actually, I think he's a phenomenal CEO. I heard good things about him from Intuit investors that I had heard from. Now, with Grab, I think that this is just, it's if I had to sum it up, it's a better, because we're at the 1 hour mark, I'm just kind of going through everything one last time. But Grab is kind of like a better version of Uber in Southeast Asia, but not China. So no China risk, better balance sheet, better gross margins, no crappy money burning freight business. They do have a fintech segment that burns money, but the metrics seem to be improving. All in all, I like Grab a lot. I think in a couple years, people will probably be saying, how come we slept on this? It was so obvious. Or at least that's my distinct hope. I think that the idea that a competitor moves in and tries to take any substantial amount of market share from them is silly. They can crush pretty much any serious attempt at competition, like an insect, like a cockroach, because they have basically no debt. They have a war chest. They have gross margins that are better than Uber's. Like, who is really gonna try to actually try to take a bite out of Grab and actually succeed? I don't see it happening. Their competition is all fragmented, and in different countries. They have local and single country competitors, no regional powers competing against them. And the bear case on the Morningstar research is a conglomerate with a large war chest could come in and do something. The only conglomerate in this business with the financial power to do anything is Uber, and their CEO sits on Grab's board, so it's just not happening. It's not a realistic bear case. I mean, my bear case would be that their fintech thing wastes money similar to Uber's freight business and ends up not really materializing into anything profitable, and even after a couple years. That's my bear case with Grab. It all has to do with if they can't be profitable at their fintech and become the super app they want to be. But I think they can be profitable just as a delivery and rideshare app. In fact, the rideshare part already is quite profitable. HITI. This is one where the business itself produces strong cash flows. They're growing within their original market, which is Canada, probably expanding to Germany soon. And since it's in the cannabis business, if the right thing happens in the American elections and the market predicts a possibility of an entrance into the American market anytime soon, you could see a wave of enthusiasm and a potential rapid multi-bag on this. Granted, you don't need that to happen for it to be good because the cash flow is already strong. They're growing within Canada, probably getting into Germany soon, since they're hiring for an operations manager person over there. Seems like that's probably going ahead. This gives you multiple ways to win. It could be a slow build, and you could see the price just improve with the fundamentals, or you could get a wave of enthusiasm that gets you your multi-bag fast. I don't know which one it's going to be, but I like stocks that give me more than one way to win. And CLOV, not really looking to add any more here. This enthusiasm was really sparked by some insider buying and maybe some institutional interest. There was a couple of sequential quarters of free cash flow. There's some potential with the Clover Assistant, etc. But it's still it's volatile and inconsistent, and just as easily as the share price got to this point, it could possibly crash back down again. I had a stop loss in place. It got hit. I lost the shares I had in my value account. I have a little more in my Vanguard, which I'll let run for a while. That's pretty much where we're at for the coming week on these stocks in particular. Mainly looking to add the Amazon. Grab as well, maybe if it stays cheap. Probably not adding more MPT. Disney up to 100, Amazon up to 200. Grab, probably anything under $4 is probably pretty good, I would think. HITI, maybe anything under $3 is potentially worth adding it. But Amazon's the one I'm really focused on at the moment. I definitely do appreciate all you coming by this Sunday. If you like this kind of thing, I would definitely be open to doing this more often. I actually like the live stream format because I get to talk to people in real time versus just filibustering to a camera for a period of time and then uploading it. By the way, while we're wrapping this up, I want to remind you guys, I am on the X platform, aka Twitter, at Mr. Macho Mog. The link is in the description. I'm not as strictly focused on finance there, though it does come up. I do a lot of other stuff too. I kind of troll replies a little bit. I try to be funny. I think I'm pretty funny. You'd be here more often, but you're not a millionaire yet. Yeah, I hear you. I hear you. Maybe you should just all into yield max, YOLO into yield max, so you're making $10,000 a month of passive income. Then you'd have plenty of time. You could retire early. But yeah, I definitely think you should follow me on X if you're on that platform. I'm trying to get to my first 500 on there. It's growing pretty steadily, but I suspect a lot of the followers are just fake accounts or bots, to tell the truth. Also, you should be watching the Cashflow Kings live every Saturday at 8 p.m. Eastern. We have some pretty great guests on there. Personally, I think last night's show with Dividend Dude was one of our stronger shows. The comments get pretty heated on there. Rumi. Okay. I know I was doing like the wrap-up stuff, but Amazon, Grab, and probably Disney. Yeah. So yeah, Amazon, Grab, and Disney probably are. And you could, I guess, probably throw High Tide in there. Medical Properties Trust, I wouldn't say is bad to add at today's price. It's just I already feel like I'm maxed out on how much I want to have in that one name. Oh yeah, well, so honestly, it doesn't bother me at all. I don't really use any of my personal views or morals or anything like that to inform any of my investments. It's all pretty much down to what I think the financial performance is going to be. So with Disney, they turned profitable on streaming as a whole. They own probably the best IP in as far as like how much variety, how many like great well-known iconic franchises they have, more so than anyone else. Like they've got all of Marvel, all of Star Wars, the entire Disney vault going back 100 years. It's the strongest lineup of IP pretty much in existence, and it's a good flywheel effect with their parks because they're super fans. Anytime something comes out, will want to see the new attractions they put up at the parks surrounding those things. So the Star Wars attractions that go up fills up the parks. Any new Star Wars movie fills up the seats at the box office. Yeah, so a recession might put a little dent in them, but I don't think they'll lose Disney Plus subscribers, and the super fans are still going to go to the parks. Yeah, right. So, hey, if I cared about, I think it's a rabbit hole to start caring about your personal beliefs and morals when it comes to investing, because I can find something morally objectionable about any company with a market cap above, let's call it like $10 billion. I guarantee you I can find something. So the question is, do you want to really start to play that game, or do you want to just buy what you think has the best chance of getting you a return on your investment? Because, hey, my second largest holding right now is British American Tobacco. Another one of my holdings is Smith & Wesson. You cannot get around the fact that those products cause physical harm to people. Yet, one of them is a vice that people willingly choose to consume, and the other is necessary for personal protection, for police, for military to exist. So the fact that people are physically harmed by those things, it doesn't bother me as an investor, because those things are, one, a choice in the case of British American Tobacco, and two, for Smith & Wesson brands, well, again, you need some means with which to protect people's rights and to maintain order in a society and to defend the sovereignty of a country, and firearms are the way we do that. So there you go. So the thing is, guns are cyclical. So I only need one, and I chose Smith & Wesson. Partly because, like, I know Smith & Wesson doesn't have debt. I know that they're committed to raising the dividend and to buybacks. So I figured while I wait for the cycle to play out, I at least get some value from the buybacks and dividends. So I went with Smith & Wesson. I haven't really looked into Sturm and Ruger because, again, Smith & Wesson's doing the job. If the election cycle plays out the way it usually does for gun stocks, I think we'll see Smith & Wesson hit 20 plus a share, and if it does, then I'll probably exit somewhere in that area. I don't know exactly what price, but I have been contemplating it, and it'll be a really good gain, and I'll be pretty happy with it. And you'll probably see the same thing if you look at Smith & Wesson as far as fundamentals versus price. But you have to, the thing is, you get the best results out of the gun cycle when you buy when it looks the ugliest in terms of fundamentals versus price, and it's really beat up, because the sales cycle tends to pick up in these election years, especially if they're hotly contested and there's a lot of like potential civil disorder and unhinged rhetoric, etc. So it'll be interesting. Also, by the way, British American Tobacco, I didn't really discuss it much here on this, but before I go, and I promise I'll go in the next few minutes, it's British American Tobacco. 6 times free cash flow. 6 times free cash flow. Who are their peers? Altria Group, who only sells in the US, by the way. 10 times free cash flow. So I got a bunch of British American Tobacco when it was actually 5 times free cash flow. So I've got a pretty good gain on that right now. Like, well, it's not huge, but it's decent, and I've collected a lot of dividends. But imagine if they expanded to 10x their free cash flow. I would basically get a 100% gain on the stock. And if you want to really look at, and this is the other close peer, although people say that because they have ZINs, they're actually better. 18 times free cash flow for PM. Now, because ZINs is like a category leader and it's global, people are saying like that deserves a higher multiple for PM, but BTI has a lot of very competitive products as well that are outside the combustible category. And in the combustible category, they're global, which includes the US and other Western countries, but also the emerging markets. So yeah, I like BTI a lot. Just as a, for those of you that can stomach being in cancer sticks, basically. So with that, I am going to once again remind you guys to subscribe, like, hit that like button, by the way. You need to do that. Also, Discord in the description. Follow me on X. Help me get my 500 on there. Cashflow Kings Live. All the links are in the description there. And a little bit of a mystery, but I'm going to hint at something. I actually just agreed to take on a partnership with a brand on the channel. Not going to tell you who it is just yet, but that should be interesting. And I'm taking some time to try out the platform before I start mentioning it in any videos, just to make sure that it's as good as it looks and the functionality is there, because I wouldn't want my name to be associated with something that I myself would not use. So but maybe in the coming days you will start to see that show up. So by the way, the deal I have is such where if you use the aforementioned service or product, it will benefit me a lot. So hopefully people like what I end up pitching with that. So that's about all I got for you today. Look forward to seeing what happens this week in the markets. I'll be in Discord if you guys want to talk. I'll try to do this a little bit more often. I think it'll be fun. But otherwise, take it easy, everyone, and have a wonderful rest of your Sunday.